Today, we're digging into a classic Wall Street head-scratcher, Univest Financial's fourth quarter 2025 earnings. Now, on the surface, it looked like they hit a home run, but the market's reaction? Well, that tells a totally different story.
So get this, Univest reported a record quarter. They beat analyst expectations on earnings per share and on revenue. A solid beat by any measure. And yet, the day after the call, the stock sold off, closing down over 2%. So the big question we've got to ask is simple. Why?
To get to the bottom of this, we've got to dig a little deeper. We need to get inside the numbers because, those headline figures, they only ever tell you part of the story. The real narrative here is buried in the details.
And look, to be fair, the good news was really good. Management was right to highlight their record earnings for the full year. They also made some serious progress cleaning up the balance sheet. You can see their non-performing assets dropped quite a bit. And on top of that, they kept sending capital back to shareholders, buying back almost 500,000 shares in the quarter alone. All signs of a really healthy, confident company. Which, of course, brings us right back to our main question. With a record year, improving credit quality, and strong shareholder returns, what on earth could have spooked investors enough to hit the sell button? Well, the answer lies in one single critical metric.
And here it is, 3.10%. That was Univest's reported net interest margin for the fourth quarter. And believe it or not, this one little number contains the entire story of the market's hesitation.
So for any bank, net interest margin, or NIM, as everyone calls it, is basically the core measure of how they make money. Think of it as the difference between the interest they earn on loans and the interest they have to pay out on deposits. Now here's the kicker. Management noted that their core NIM was actually strong, but the number they had to report was getting artificially dragged down by about 27 basis points. And the culprit? Something they called excess liquidity. It's just a fancy way of saying they had too much cash sitting on the balance sheet not being lent out to earn a high return.
So, facing this problem, what was management's plan? Let's pivot and look at their guidance for 2026 to see exactly how they plan to navigate the year ahead.
The game plan is pretty straightforward. First, they're looking for modest loan growth, about 2 to 3%. Second, they're aiming to achieve what they called a modest expansion in that all-important net interest margin, which makes sense. They're going to put that excess cash to work. And third, you combine those two things to drive 4 to 6% growth in their core revenue engine, a solid, if not spectacular plan.
And on top of that growth plan, they committed to keep rewarding shareholders. They're going to maintain the quarterly dividend, and they're targeting $10 to $12 million in share buybacks each quarter. This is a pretty strong signal to the market that management thinks their own stock is a good value.
Okay, so we've seen the strong quarter, and we've seen the solid plan for the year ahead. Now it's time to put all the pieces together and finally answer why a stock with this kind of story would end the day in the red.
Let's just frame the disconnect one more time. The backward-looking results? They were fantastic. The forward-looking plan seemed perfectly credible. So where is the gap? What did the market see that justified selling? It really boils down to this. The market was simply hoping for more. Investors were likely looking for either a clearer, faster path to fixing that net interest margin drag, or they wanted management to guide to even stronger growth in 2026. The guidance was good, for sure, but it wasn't great enough to overcome those near-term concerns about profitability.
And this gets to the heart of how markets work, right? The market is always forward-looking. That record fourth quarter was already in the rearview mirror. The beat was history. What mattered was the future, and the future, at least for the next couple of quarters, included that persistent drag on NIM. That's what investors were focused on.
So with all that context, where does this leave the stock? Let's move to our final section, the next call, where we lay out our thesis and what we'll be watching for.
All right, it's time for our take. Here's the next call on Univest Financial.
Our rating is market perform. The thesis is simple. Univest is a well-run bank with a solid plan. However, that near-term pressure on its net interest margin, it's probably going to act as a ceiling on the stock's performance. We just don't see a clear catalyst for it to significantly outperform until that excess cash is fully put to work.
So what could change our rating? Here are the 3 things you should watch. First, how quickly can they deploy that excess cash in the first half of the year? That's catalyst number 1. Second, can they find ways to expand their core profitability even faster than their modest guidance suggests? And finally, how aggressively will they actually execute on that buyback plan? These are the data points that will tell us if the story is improving faster than expected.
This is not financial advice.